So far, we've looked at the criminal's playbook, the techniques used to launder money. Now, let's switch sides completely. Let's walk into the fortified, highly regulated world of the bank's defense team. Imagine a constant, high-stakes game of cat and mouse played with algorithms, regulations, and billions of dollars on the line. The cat isn't a person, it's a system, a process, a regulatory machine. When you deposited that check or made that wire transfer last week, you triggered a silent, invisible series of checks and analyses you likely never considered. Banks aren't just vaults for money. By law, they are the frontline sentinels of the financial system, mandated to detect and report illicit activity. But how? It's not a room full of people staring at every single transaction. That's impossible. The reality is a sophisticated blend of human judgment, rigid rules, and increasingly, artificial intelligence. Today, we're going behind the velvet rope. I'll explain the three core technological and procedural pillars banks use: the gatekeeper at the door, the omnipresent surveillance system inside, and the critical decision to call the authorities. The first and most fundamental line of defense happens before any suspicious transaction even occurs. It's called Know Your Customer, or KYC. This isn't just asking for your ID when you open an account. It's an ongoing, risk-based process of due diligence. When you apply for an account, the bank must verify your identity not just with a driver's license, but often by checking you against databases for politically exposed persons, PEPs, sanctions lists, and adverse media. Are you a foreign official? Are you on a terrorism watch list? But KYC goes deeper. They must understand the nature of your business and your expected financial behavior. If you're opening a business account for a small consultancy, they'll ask for expected transaction volumes, types of clients, and sources of funds. This creates a customer risk profile. A retired school teacher with a pension gets a low-risk profile. An international art dealer who deals in high-value, portable assets and uses cash gets a high-risk profile. This profile is crucial because it sets the baseline for monitoring. The pro tip, and a common point of frustration for legitimate customers, is that KYC is intrusive by design. If your bank asks for a letter from your lawyer explaining a large deposit, it's not personal suspicion, it's the system working. The red flag for the bank during KYC is evasiveness. A client who refuses to explain the source of their wealth, who uses complex corporate structures with no clear purpose, or whose stated occupation doesn't match their lavish lifestyle. This initial profile is the foundation for everything that comes next. Once you're a customer, every transaction you make feeds into the second pillar, the Transaction Monitoring System (TMS). Think of this as a 24/7 financial surveillance camera with a very smart brain. This isn't one system, but a layered one. The most basic layer is rules-based scenarios. These are simple if-then statements programmed by compliance teams based on known topologies. If a series of cash deposits just under $10,000 totals over $50,000 in a week, then flag for potential structuring. If a wire transfer is sent to a high-risk jurisdiction on a sanctions list, then flag immediately. If a dormant account suddenly receives a $500,000 wire from an offshore entity, then flag. These rules catch the obvious, textbook patterns. But criminals know the rules, so they adapt. That's where more advanced behavioral analytics and machine learning models come in. These systems don't just look for rule breaks, they learn what's normal for you and flag what's abnormal. For you, the school teacher, a sudden $2,000 wire to a cryptocurrency exchange might be highly unusual and get flagged. For the tech entrepreneur, it might be a daily occurrence. These models analyze a vast array of factors: time of transaction, counterparties, geographic locations, sequence of events, and even the way you log into your online banking. They look for clusters, networks, and subtle deviations from a pattern. The insider secret is the problem of false positives. For every one truly suspicious transaction, these systems might generate hundreds or even thousands of false alerts: the retired teacher sending a large gift to a relative, the small business having a great month. This noise is the biggest operational challenge for banks. This leads us to the critical human element and the third pillar, the investigation and SAR filing process. When the TMS throws up a red alert, it doesn't automatically mean a crime has occurred. It goes into a queue for a human AML investigator or analyst. This person's job is part detective, part historian. They must pull the entire customer file, review all related transactions, and attempt to either clear or escalate the alert. They look for a legitimate business rationale. They might contact you, the customer, for an explanation. If the analyst cannot find a reasonable, documented, and verified explanation for the suspicious pattern, the case is escalated. This is where the crucial decision is made to file a suspicious activity report, or SAR. The SAR is a confidential document sent to the National Financial Intelligence Unit like FinCEN in the U.S. It's not an accusation of crime, it's a statement of suspicion. The key here is that the bank is prohibited from telling the customer a SAR has been filed. This is the tipping-off offense, a serious crime itself. The bank must also make a difficult choice. Do they reject the transaction, delay it, or let it go through while filing the SAR? Often, to avoid tipping off the suspect, they let it proceed under surveillance. This is a critical nuance. The system is designed to identify and report, not always to stop in real time. The common mistake people make is thinking the bank's compliance team has law enforcement powers. They don't. They are a source of intelligence. Let's walk through a concrete example to tie these pillars together. Imagine a new customer, Alpha Trading LLC, opens a business account. KYC reveals it's a wholesale electronics importer owned by a holding company registered in a secrecy jurisdiction. Medium high-risk profile. For 3 months, activity is modest, payments to known Asian manufacturers, invoices matching. Then, the TMS fires an alert. Rule breached, multiple rapid, sequential wire transfers just below $100,000 internal threshold, totaling $950,000 in one day, sent to a newly created company in a different high-risk country. The behavioral model also flags it. This volume is a 1,000% increase from the historical pattern. An analyst gets the case. She reviews the wires. The stated purpose on the payment orders is vague, for professional services. She checks the recipient, a company incorporated last week. No website, no business history. She requests supporting contracts or invoices from Alpha Trading. They provide a poorly formatted, generic contract for market consultancy. She escalates. The senior investigator, seeing the layering pattern, the high-risk jurisdictions, the lack of commercial substance, and evasive documentation, approves the filing of a SAR. The $950,000 has already been sent. But now, the Financial Intelligence Unit has a report linking Alpha Trading, the shell company, the jurisdictions, and the method. They can potentially link this to other reports, building a wider picture for law enforcement. The system, however, has significant pressure points. The sheer volume of false positives means analysts are often overworked, potentially leading to alert fatigue where real threats are missed. Criminals also engage in low and slow laundering, keeping transactions small and consistent to fly under the radar of rule-based systems, relying on the behavioral models to catch them. Furthermore, the global patchwork of regulations means a transaction that looks suspicious in one country might be harder to spot in another with weaker laws, creating weak links in the chain. This is why collaboration between bank compliance teams, FIS, and international bodies is so crucial. The pro tip for criminals, which we expose to highlight the defense, is to study the thresholds and try to blend in, but the advancement toward AI-driven behavioral networks is making that blending increasingly difficult.